Welcome again and a very good afternoon to all of you. My apologies, partly the traffic, partly I've been very busy in the market this morning. Now I'm going to just quickly run through as similar like before, the third quarter, and then give you some color as to what we believe will happen in the fourth quarter. Certainly very nice to see a big group this afternoon. But I think the basic message is very, very simple, okay? We are definitely not out of the woods yet. That's why we believe there are still a lot of challenges as we move into 2014. But the message is also perhaps quite clear: buy on dips, okay? Now, the reason why I say this is because I think next year, despite all the uncertainties in the global markets and things like that, okay, I believe we're in a cycle, as I may have mentioned before, we are in this early interest rate cycle, okay? Now this early interest rate cycle is very important because I went through this, I mean, I've been in this industry, as you know, for about 29, close to 30 years now. And what I do remember is every time during the early interest rate market cycle, it tends to be good for equities, okay? And this was very clear in 1994, and the other year was in 2004, okay, which I will, I think I may have gone through those in my previous charts, but I just want to let you know that generally, I think equity as an asset class is still going to be positive next year, okay? Very quickly, I won't spend too much time. I think the key point here, what we are trying to say is that for the last quarter, all your ASEAN market are basically unfortunately pulled back. Even Malaysia, last 3 months was down a little bit, but where the market suffered most was Indonesia, Philippines and Thailand. Now you may recall, year to date, these three markets at the beginning of the year, it was actually a big positive. It was up about, each of these markets were all up about 20%, okay? And you look at this 20%, as at June it was up 20%, and look at it today, all wiped out. You know, Thailand, you see, Thailand, Indonesia, all the gains 20% all wiped out, okay? And what has happened is that over the third quarter, basically we've seen the North Asian market actually outperforming South Asia, okay? And I believe that's going to happen again in the second half of this year, and I will come to that very soon. So basically, ASEAN came down was because there were a lot of currency worries. As you know, not only Malaysia, the rupiah, Thai baht was also hit very badly. And for them, it was even worse because they had deficit worries, especially on the current account. Malaysia also, we've seen some worsening, but not as bad, okay? So basically, I think generally our market was still holding up better than expected, despite second quarter numbers. In China also, we saw some positive signs finally coming out of China. This silent stimulus, which I will come and talk about it in more detail. And another main reason why market generally recovered, that's why US, all these markets were actually doing quite well. Nasdaq did very well, is because of this non-paper, okay? But sooner or later, this has to happen. And I will give you a time frame when it's likely to happen next year. Finally, and what's surprising is even European markets now are out of recessionary zone, okay? So just to highlight, massive profit taking in ASEAN, as I mentioned, current account, all in some ways suffering, India, Indonesia, and that's why the currency suffered even more. Likewise in India also, had not a country that we follow in terms of the market, but generally also affected very badly. Malaysia, as I mentioned, the current account, what's very clear is that current account have been slipping, the surplus have been slipping down for quite a number of quarters. And this is becoming more worrisome in the sense that, you know, they may be further downgraded by Fitch down the road, which unfortunately I don't think will happen. and wasn't expected. I think there will be more next year. Be prepared for more fuel price hike next year, as the government will want to reduce subsidies further. As I mentioned, GDP for Malaysia wasn't positive at all. In fact, a lot of people at that time was going for closer to about 4.7, 4.8, and the government only came out with 4.3, okay? Which means that I think second half this year, although there's some pickup, momentum will not be as, it will still be stronger than first and second quarter, but it will be below the consensus earlier expectation. Okay, and the key reason is because exports and federal government expenditure, we will see further fall there. This is the, as I mentioned earlier, Fitch downgrade. There were all sorts of concern over the fiscal side. As you can see here, it's still 4%, a bit on the high side. Government target is of course trying to bring it down to around this level, which will be a real challenge for them. Okay, going forward. This is the stimulus package that I was talking about. Now you remember China during the 2008, 2009, when they went through the stimulus then, it was very big. Some of you may remember it's $4 trillion US. And that time when they did it, it's very different from this time round. Last time what they did was they directly injected in a lot of projects, a lot of them through banks and a lot of them direct projects. But this time around is different. Basically what they've done is they encourage the banks, they push the banks to actually lend out to the local government, i.e. Shanghai government, Guangdong government. They in turn will then go and spend the money and ensure that growth is propped up. See, one of the biggest problems that China has is the fear that GDP growth may come down to about 7% or below. Okay? Now anything, as you know, if it comes down to 7% or below, for China's standard, a GDP growth at 7% or below is quite negative. Okay? Although for other countries, if they can see 7%, that's fantastic growth. But in China, what they're trying to do is they're trying to fine-tune growth. But the basic message is growth will slow down, and it has to slow down. So do not be surprised, even next year and going forward, I think the long-term growth for China will trend towards 6.5 to 7%. Okay? So be prepared for that. It's just that the investors somehow have been so used to the 8-9% growth in China, they think that, oh, you know, this will remain, but it will be very, very difficult to duplicate those kind of growth. So naturally, growth will have to fall down as a result. Okay, and as a result of all these silent stimulus, what we've seen is that, you know, we have seen some improvement in fixed asset growth, and retail have expanded, and even exports have also picked up somewhat. But don't forget, exports have picked up is really because of the so-called subdued global recovery. As I mentioned, surprisingly, US economy appears to be showing a lot of resilience, and all the numbers which are coming up, home sales, housing start, existing home sales, all of it have actually turned up positively. Okay, I think the big challenge is not now, but in the next 6 months and into next year, can they maintain this momentum? Okay, the answer is, I think it will be very tough. And what you will expect is that probably in the fourth quarter, I think you will get some negative GDP forecast coming from the US, which will give the bond market a reprieve, a temporary reprieve. Okay, so that's something to watch out for. And surprisingly, even unemployment in the US is improving, but there will be a dip in the fourth quarter because of the recent government shutdown. Okay, I'm sure all of you would have heard of the government shutdown, and I think that has been very painful for the US government. Now, as I say, finally, US, European Community, EU, have come out of the recessionary zone. You can see here, touching briefly above 50 is a very positive sign, and likewise in the Eurozone, they've gone above positive, back to positive. So it's a broader based recovery, but I think it will be a subdued kind of recovery. It will not be a massive recovery. So something we should watch out for. Okay, very quickly on some of the fund performances. I think generally most of the fund's performances, I would say some have done well. I think our Progress Fund here, year to date, up about 28%, so we're third, have done quite well selectively. Even some of our overseas funds have picked up, but generally most of the trying to maintain most of the funds in the top and second quartile. So most of them have achieved that, with exception of the index funds. Yeah. Bond has been very tough for fixed income market generally. Okay. And Asia Pacific side selectively have been quite tough as well, but we have come out of the bottom there. Okay. Now, more importantly, going forward. Okay. Now, as I said, in terms of the US taper, okay, and what we've seen is that the fact that the US taper has been delayed. Initially, there were all sorts of concern saying that US taper will come. Some were saying in September. Now it hasn't even happened. Then what happened was June, July, August, the bond market tanked globally. And I think it even affected our Malaysian bond market. And what it meant was that a lot of foreigners actually took money out of the local bond market, which I will come to in a moment. So what it meant was that bad for bonds, but the fact that they did not taper, suddenly all the bonds sort of retraced and recovered somewhat. Now what I believe is that come next year, if you believe that the taper is going to happen, which I think it will, but very likely they may not do it till, I think possibly they may do it one time, maybe in the first quarter, towards maybe March. The other one is maybe middle of the year. So these are the two interest rate signs that you have to watch out for next year, which I think will happen, which means all these bond yields, this US bond yields will start to trend back up again. So if it trend back up again, that means may not be that positive for bonds generally. Now, this is the reason why I believe equities will be positive. Just imagine if I'm sitting in London or New York, okay, I've got a huge amount of funds. I'm going to take money out from fixed income, which is what they have done. Okay, but don't forget, they have not taken a lot out, which I will show you afterwards in Malaysia and in Thailand, Indonesia. They still have a lot, despite the fact they just took a little bit out. That was sufficient to bring down the regional currencies. Okay, so what I'm trying to say is that if I was sitting in New York or London or wherever, I take money out from the bond market. I have to put it somewhere. I have to put it to work. Okay, so by default, what I believe is that it will go into equity markets, and generally all your PE multiple, whatever you think now may be expensive, but it will get more expensive. So this is the scenario that I saw back in 1999 and 2004. Okay, equities subsequently 1 to 2 years subsequently were generally positive. Okay, so that's why I believe maybe if you believe the same thing will happen, okay, 2004, 2005 maybe still okay for equity. Beyond that, I think we have to be more careful, because when it comes to the tail end of the interest rate cycle, that's when it becomes very dangerous. Now the difference between the tail end and the beginning, which is now the beginning, is at the beginning, you will see earnings recovery, and that's what we are seeing in US, in Europe. Okay, so corporate earnings growth will recover. Number two, economic momentum will also recover. And just now I showed you the slides in Europe and also US, it's all recovering. So again, this is exactly the same signs I saw in 1999 and 2004. Okay? Now, the only big difference is, now compared to 1994 and 2004 is this. In 1999 and 1994, US interest rate, when they started moving up, okay, it took them a period of almost 1.5 to 2 years, okay, and it moved up by about 300 basis points. That is US rates, 300 basis points. Now, the big difference is, that time and today now, moving forward into 2014 and 15, I don't see those rates going up so much. You may ask why. Very simple. 10 years ago, 15 years ago, and today, the US government and the European government have taken a lot more debt. They have to pay for this debt. Correct? So if they go and inject up interest rate, the government themselves have to pay more money. Okay? So now the big difference is, now and last time is, interest rate will still go up, but it won't go up as much. So what I'm saying is that maybe for the US, it may go up 100, maybe 100 basis points, quite painful, possibly 150 basis points. Okay? But when it comes to Malaysia, you look at OPR. OPR has not moved, it's still at 3%. I don't think it's going to move, it's going to remain at 3 from now to end of the year. Okay? But next year, they would have no choice. If global interest rate goes up because of US, okay, I think regionally they have to move rates up also. Very simple. If they are behind the curve, and Malaysia, if they don't raise interest rates, what will happen? Our ringgit will tank. Our ringgit will depreciate further. Okay? Now, we have seen, beginning, say June, July, August, when the foreigners started taking money out, we saw the ringgit weaken from 305 to I think 320 something, you know, high 320s very quickly. Okay, and now it's pulled back a little bit, you know, back to 3.12 around these levels. But what I'm trying to say is that there is still a risk that there may be currency weakness. Okay. Now this currency weakness this time round is not because of inflationary fears. Last time people always say, oh, inflation going up, and then we have to push interest rate up. Now this is not going to be the issue this time round. If interest rate were to go up, it's not because of inflationary pressure, but it's because of potential currency outflow. Okay, which could happen if US rates goes up, we lag behind. That is what is going to happen. That's why I do believe regional rates will have to move in tandem. But the good news is that maybe Malaysia do not have to move up so much. Okay, so what I'm really expecting is Bank Negara will only move it by 25 to maybe 50 basis points. Hopefully maximum for the whole year next year, only 50 basis points. Okay, now unless we continue to see bond outflow, which I will come to the bond outflow in a moment. But what I'm trying to say right now is, the other positive sign is US, because of the government shutdown recently, it will affect fourth quarter growth here, okay? And because of that, okay, one thing good is also, it will stop the US dollar from strengthening. Now that was another clear-cut sign which has happened this year, US dollar strengthening. Same thing, it happened in 1999 and 2004, same thing. That's why I'm saying the signals are so similar from what I went through. Okay, we also went through this rise in US dollar now as compared to those periods that I mentioned. Okay, so again, all these similarities is coming together. Yeah. So what I'm trying to say is good news. What this tells us is that the US taper may not happen this year, but the likelihood is they can only delay it, so it will come sooner or later. This is the other good news, okay, which is China. China has been very, very disappointing. In fact, the new leaders, which initially I thought they will come in and pump prime the economy, that didn't happen. They came in instead, they started whacking and started looking at corruption, lavish spending by the government, you know. So that was what they did. And because of that, growth actually slowed down. Okay? Those of you who drink all those heavy Chinese wine, you know, MOT28, okay, MOT28, those were selling like hotcakes, you know, in China. Beginning of the year, it was still doing quite well, you know, but last year, the year before, doing fantastically well. All the prices went up to one bottle can be 1,000 something, okay? And what they did was, the government agency buy all this in bulk for entertainment, give to government agencies, government people, you know, SOEs and all these. So that's why consumption was very strong 2-3 years ago. But this year, because of this corruption clampdown, which is still happening, okay, it's affected consumption growth, both private and also public. And because of that, okay, we went through a very tough patch. But now, the new leaders are getting worried. You know, beginning, sometime middle of the year, when people say that, oh, China growth may even come down to below 7%. Then the Chinese the new leaders suddenly woke up and said, hey, we can't afford to let this happen. Okay? So they started introducing what I mentioned just now, the silent stimulus. Okay? So that, in a way, started boosting some of the consumption and local government spending again. That's why I think growth in China is going to be very managed. The moment they think it's slowing down, then they will open the tap a little bit, you know, let it grow. But the moment if it grows too much again, above 8%, then they will announce they close the tap and announce more tightening. No, we're in that scenario, unfortunately, okay, for China. So they'll keep fine-tuning the spending. Another very clear-cut sign here is this is what we call total social financing. And this is, in a way, we call it M2, M3. It's a monetary gauge, okay? But they call it social financing. The key thing is that normally when this goes, this only started moving up, you can see, in July, August. Normally when this goes up, it tells you your economic momentum should start to pick up in China. That's why we started seeing North Asia doing so well. Okay. So this one, exports really depends on US and Europe. If US and Europe come back down, I think this will also come back down. But for now, everything has spiked out. So exports is looking good and is benefiting China also. Okay. This is just to say that, look, I know there's a lot of concern, people talking about the fiscal deficit, the current account and things like that. So whatever it is, what's very clear, we will not have a repeat of 1997 when we had the stock market go up. The reason is because our reserve is so much stronger, and you look at the percentage import, is all a lot stronger now compared to these years, okay? So nothing to worry about. Coming back to Malaysia, okay, this is the key. Focus on this chart, okay? These are the bond yields. This is MGS, which has done very well. That's why, you know, those who invested in bonds generally have done very well, but this is where you saw the pullback on the bonds. Okay, so this is the pay period, this is the pullback period. Okay, now I ask you to concentrate on this. This one is your money market, okay, which tells you still a lot of liquidity, okay, in the system. That's why we're not too worried. But what we're worried is this MGS. Can you see here, the foreigners, these are the foreign holdings in Malaysian MGS. Back in 2008, 2009, they only had about maybe 13-14%, okay, and then going up to about 18% here towards 2009, about 18%. That means of all the total MGS issued in Malaysia, foreigners was holding 17-18% during this late 2000 year. But you look at all those years when US dollar was weakening, and there were all those concerns that US was going into recession. Back into the 2008, 2009, the Lehman crash, the housing debt issues, mortgage, all these in the US. Okay, then what happened? The foreigners, or US or UK, whatever, they put money into emerging markets, which was why, and emerging market bonds. That's why MGS bonds if I look at the MGS bond holdings in Indonesia, Thailand, very similar pattern. Foreigners then started buying bonds, buying bonds. The peak, 2013. Okay? Now, you see, in May, June, July, August, when fear of the taper came in, the foreigners started selling. Okay? And this is from about 44% to 41%. That sell down in the bond holdings by foreigners is sufficient to push your ringgit weaken from 305 to almost 330. Yeah, you may recall. So the danger is, what if the foreigners were to sell it back to this level, back to square one? Whatever they have bought will come back to square one. Okay? The first thing that is going to happen is say goodbye to your ringgit. Okay? Say goodbye to your ringgit. Now, the good news is, I do not think the ringgit is going to weaken now. You go back to the Pan-L crisis. Those who are Pan-Electric, those who are old enough or young enough to remember the Pan-Electric days. Okay? During those days, our currency weakened big time. Okay? Even the currency crisis back in 1987 was the other one. Okay? The rates went up, ringgit went up to $4 Can you remember that? Okay? And the other crisis was, I think the before this 07, 08 period, the other weakness is it went up to about 3.7, 3.8. So what I am saying now is that because Europe and US, the picture is not all that clear. Okay? They are not totally out of the woods. So that's why I believe ringgit is not going to go back to those alarming levels, 3.8. That's very, very bad. There will be huge imported inflation if that were to happen. And also this time round, Bank Negara is so much stronger. The amount of liquidity in the system this round is about is about 280 billion. So they can then make sure that some of this liquidity will go back and help the ringgit from falling too much. So what I'm saying is that yes, be prepared. Foreigners will continue to sell down. Or whether they sell down to 30%, 35%, I do not know. Okay? But what it just tells me is that it will put a cap on the US appreciation. That means it won't go back, appreciate below $3 again. Very tough. Okay? In any case, I think the ringgit will be under some pressure, but I think every time, if it does go back to 330 recently, you already saw some intervention by Bank Negara. This time round, I think at 330, and the other one will be about 350. They will come in and intervene again. And now they're in a better, financially stronger position to come and intervene. So what we're saying is that yes, be careful because it will take some time for the foreign investors to unwind this position. And now, if Malaysian government is very stubborn, i.e. in not increasing rates, don't forget Indonesia have raised rates 4-5 times this year alone. Malaysia still hasn't increased rates. Indonesia 4-5 times, Thailand twice. Okay, Malaysia 0. So what's going to happen if we do not do anything? Foreigners can only think of one thing: sell down on the Malaysian bonds, which will hurt the ringgit. And why? Because Indonesia, by hiking the rates, then the bond yield becomes more attractive for the US investors to hold on, because the yield differential has widened between US Treasury yields and Indonesian bonds. It's widened again because of the rise in interest rate. So this is something that we must watch out for very closely. And this is the exchange rate, as I mentioned, okay, recover a little bit. But these are the two levels that I think we will not go back to this level. I think at worst, maybe about beware. I think the 3.5 is very, very possible. 3.4, 3.5 is very possible if there is a heavier sell down in bonds. The other risk is, I think most of you are aware, you know, those times a lot of people buy 2, 3 condos or apartments or whatever, you know. Now I think with the government addressing sort of this problem, i.e. making more difficult to get housing loan, which it is. Last time housing loan very simple, based on gross. Now they use net salary. Now they reduce the number of years. Okay, so what it means is that affordability will get tougher. Okay, and banks themselves are making very, very difficult to extend household mortgages. So I think because of that, and because our household actually in Malaysia, we are really quite high. If you look at this, this is our household debt as a percentage of GDP. Malaysia is almost 83, it's below US and Korea, but this is a very high figure. That means, you know, a lot of people have geared up over the last 5 years or so, buying property, not just one, maybe 2 properties. Okay, so this is what it's telling you, and Bank Negara is really taking steps to make sure that this doesn't go up anymore. Okay, but that will affect men on the street generally. Now, coming back to Malaysia, as I said, if there is any opportunities, a dip or whatever reason, which can happen, okay, and there are still many risks around. Like the next year, you know, the tension between Japan and China over the Diaoyu Islands and things like that, all these can blow up at any time. Okay, what I'm saying is that you see any market dips for assets, generally, I think for equities, there will be a lot of support of strong buying at lower level. So even if people were to sell down, but I think the institutional clients are the people, global institutions who come in and buy more equities. They're shifting, remember, they're shifting asset class from fixed income to equities. So be mindful, that is what is happening. As we mentioned here, equity will still remain compelling. Liquidity, as I said, is about 280 billion in the market right now, so I'm not concerned. This fourth quarter, generally the consensus is going for a stronger fourth quarter, and next year's growth generally for Malaysia have been revised up to anything between 5 to 5.5% for next year. So this year we will be below 5, but next year we will see some improvement. I know as we go forward, it's not easy task for us, especially because generally stocks have gone up a lot. Market has been quite positive. So basically, we will have to identify laggers and look for value stocks within the growth sector. So what it means is for fund managers, a lot more work to do, but it's a real challenge. I think it's interesting. If we can find these stocks, we will continue to do well. And there are quite a number that we have identified, fortunately, for this coming quarter. So we are actually quite positive on that. Okay, and avoid interest rate sensitive stocks. I see they've taken off the budget from here, is it? Have they taken off the budget? Okay, maybe I'll just highlight on the budget since it was just announced. I think generally the whole of this budget, as you know, is focused on GST. Okay. Initially, you didn't hear we made a few presentations the last few weeks and the last 1 month. We say that minimum it has to, they will have to set for GST will be minimum will be 4%. Anything above 4, so happened during the announcement on Friday, they say 6. So when they say 6%, then they also mention that there is room for, I believe, corporate tax cut and personal tax cut, 1% each. Okay. Now, why we came up earlier, about a month ago, for 4%. 4% is the minimum that, because they'll be removing sales and services tax. So, they were implementing this GST. So, with this GST, basically, what it means is that if you look at the potential revenue that they will receive as opposed to the expenditure side, to break even for them is about 4%. Okay, so anything above that, they will see surplus. That's why at 6%, they will see a net surplus. That's why they can afford to give you a tax cut. But all this, as we envisage, we said it was 2015. I think the announcement came out, I think they said mid. 1st April 2015. Yeah. I think that is very probable. We thought it was going to be beginning of the year, so they have used 1st April 2015 as the time that they will increase. Now, that one actually have positive and negative. Certain sectors will benefit, certain will not benefit. Okay, it depends. And actually, some of the things are not that clear. But what it means is, net, the government is going to get more revenue. Okay. Last time, for those people who buy Magnums, Toto, and things like that, right? So you win money, right? No tax, correct? Now you win money, they put a GST, 6%. Okay. So net, that's why this GST is very, very positive. Very positive for the government. Okay. And to me, it's very good for the government, okay, because it means they will be able to broaden the tax base and they don't need to rely so much on all revenue. But the bad news is you and me, all of us, say what you like, or say I don't, whatever the government says, everything will be higher. Your costs will be higher. Okay, Singapore went through this about more than 15 years ago. The good news is, to be fair to the government, I feel they are very, very considerate. Okay, number one, if you look at regionally in ASEAN, they're all VAT, GST is all between 7 to even 10%. Okay, now implementing 6%, even better. Our Malaysian government is so considerate. Basic things like sugar or even salted fish. I don't know why they put down salted fish. Some of the basic goods, okay, salt or whatever, no GST. Now that is all very good. But it will be a big problem for those people who implement all those vending machines, all those, what do you call it, the POS machines, point of sales machine. I don't know, there's a lot more work they have to do. Okay, very cumbersome. Actually, if they standardize all this, then it will be very easy. All it means is that government will get a lot more revenue everywhere, especially on the basic things of utility. Now, they say utility also, some of it they will not charge electricity or whatever, they may not charge GST for it. So it's quite cumbersome to monitor, and it's going to be very cumbersome for them to implement and to monitor. Okay? But anyhow, that's not a problem. I think the basic problem is that costs generally will go up, so be prepared for that. Okay. Generally, I think in terms of momentum, so long as we continue to see momentum, then we're okay. This is a rolling 12-month, which goes up to October, October next year. But at year end, we are forecasting at least another 10% growth. So generally, we have a target based on that, 188 for next year, on next year's target. So I think generally, I think equities will still give you positive return. We believe they will. Be prepared. What I'm trying to say is that next year there's still a lot of challenges next year, and there will be a lot of opportunities for you to buy on dips. Okay, so take advantage of that. technically, the Pacific side, as I mentioned, is trying to break out of this resistance now. If you look at Malaysian market or whatever, we have gone beyond 2010, 20, what? This is a very strong resistance. It's for the first time, it's broken up this part here. So very likely it will trade along here. And what will happen if we even trade higher is why? Between, just now I showed you, ASEAN and North Asia. Okay? Going forward, if you believe, big if you believe global recovery, US, Europe will continue into next year, then what does that mean? Exports will be positive. And if export is positive, North Asia generally will do better than South Asia. So it's a general trend. That's why, if I go back to the table year to date, in the last 2-3 months, where have all the money gone to? They've gone back to North Asia. And I believe that the momentum will still be there. And for the first time, you will see this breakup. And I think this time round, hopefully should be sustainable this time round. Okay? As I said, if you compare this chart, okay, we are just trying to break back up to our 2011 level. Okay, look at Malaysia. We've broken out of in 2011 area. 2011 here, we have broken above already. Okay, so again, this is a very positive sign. What this tells me is that it's broken above this support area. Even if there's a pullback, this will be I think around 1730 or so. So I think your support on the index, KLCI, will be very strong support. So what I'm saying is, any dips that you see, take advantage of it, because I think generally it will stay above this red line and it will stay above this blue line as well as we go into next year. Okay, thank you very much. Happy to, any questions that you have, happy to answer. Thank you. Any questions?
Recently, the risk one has not been overcome. Do you have any comments?
Sorry, the what?
The risk one? Asia Pacific REITs.
Asia Pacific REITs fund. Oh,